Right, hi, my name is Richard Perry and I am the market analyst at Hantec Markets. Welcome to my latest webinar that I'm going to be doing for FX Street. I always enjoy the FX Street webinars because we always get such a good participation with the audience, so I'm hoping that that's going to continue today. Little quick note on my sound. The microphone that I usually use is kaput, so I've had to use a backup microphone, and I hope it's okay. If it isn't, great deal I can do about it because I'm on my last legs in terms of microphones, but I will get going. So my technical analysis presentation today is the law of multiple confirmation. Basically what I've done recently is take through trading techniques of how to engage your trading, and a few tips and ideas that I've picked up over the years. But now I want to sort of drag together all the technical analysis webinars that I've used and sort of bring it round to a point at which I can sort of describe to you exactly how I engage my trading strategy and how I use technical analysis to get my strategy across. And I do it in a way called the law of multiple confirmation. What I'm going to do first of all is just show you the disclaimer, because we're going to be talking about live market information. As per usual, I'm going to try and get through the presentation as quickly as possible, and then we can look at markets at the end. If you've got any questions, please don't hesitate to ask. I will show the disclaimer as well, so just in case you have missed it. Right. First of all, let's get going. The retail trader big issue: 90% of retail clients lose money. Now, the issues that I've spoken about previously, such as not understanding the platform, over trading, poor trade management, and an inability to use stop losses, all have a part to play in that. However, I think that if you can correctly analyse the markets, then I think that those issues become null and void. So if you can get to a stage at which your analysis is good enough that you can call the markets correctly, then you're not going to necessarily have such issues of such as sort of poor trade management and incorrect stop losses. So that's what I'm here to try and help you with today. Now, what I'm going to try and talk to you about is basically trying to get across how my techniques, I think, can help to improve the way you engage your strategy for trading. I made a lot of mistakes in my career in terms of trading, and I sort of wanted to get a few across to you today. And what I've come to sort of the conclusion is that obviously trading using technical analysis, there is so many technical indicators you can choose from. I've got Reuters Icon platform, and that's got 70, I think I counted 70 indicators. MT4, another platform that Hantec Markets clients use, is I think about 60 indicators. So even on the retail trader clients platforms, they've got a huge amount of indicators. And I don't think you can use all of them, and you probably don't need to either. I think you can become sort of a jack of all trades, and that doesn't necessarily help you in technicals. I think you want to be try and hone your skills on technicals, and that's what I'm going to try and help you with today. Now, my biggest early mistake was the fact that I used to trade without confirmation, and you're meant to learn from your mistakes, and I have done that. I learned that you can get technical indicators that are giving you a trading idea in one direction, but it doesn't necessarily mean it's going to be correct. You get false signals all over the place on charts, and you need to, I think, wait for confirmation on your indicators, because if you do that, then you get a greater sense of conviction, and you're a much sort of more you're much happier to take your positions. And at the end of the day, I don't think you're I think you're a trader. You're not a gambler, and that's why I look for confirmation across a whole range of indicators, sort of price, momentum, volume, and also volatility have all got a part to play, and I want as many indicators as possible that I look at to confirm a move to give me higher confirmation and conviction. So the paradox of choice, I suppose this sort of takes it the other way, where you've got too many options, really. I think this is where you get an overkill of information. You're looking at far too many indicators for your own good, and you get confused. Paradox of choice is basically where there are too many indicators that give you a lack of clarity in your thought, and you get overloaded with ideas left, right, and centre. and it's sort of detrimental to your decision making. And I'd say keep it as simple as possible. Try not to overcomplicate things. You're never going to get, I mean, all those sort of 50, 30, or even I suppose 10 indicators all confirming your outlook. And your job as a techie is to sort of sort the wheat from the chaff, really. And in doing so, if you can gain the maximum amount of information at your disposal from your chosen indicators, then I think you're going to get a higher level of conviction, and that is where the law of multiple confirmation comes in for me. Right, first things first, my analysis. Now, different indicators work differently at different times on different instruments, and I think the best indicator or the best chart I can use to sort of show you that is the 144-day moving average on gold. Now, you can see through 2009 to 2011, the 144-day moving average on gold was an excellent basis of support. Held the uptrend all the way through those 3 years, and it was a superb indicator. But then you started to see the indicator breaking down. You started to see the market moving sideways, and the trend was broken. That indicator started to lose its relevance. In 2013, in the latter half of 2013 anyway, you started to see that indicator getting back its relevance as the market started trending again. Once again, in 2014, we started to see sort of more sideways movement in the market, breaking the trend. But now in 2015, we're starting to potentially see the choppy trending indicator turning around into more sort of a decisive mover. And the 144-day moving average has been a decent basis for the past sort of 4 or 5 months again. So basically what I'm trying to get at is the fact that you need to constantly reassess the markets you're trading in. Are you in a trending market? Are you in a sideways trending market? Are you in a range play? Because you need to understand that these indicators are read differently in trending markets as they are compared to in ranging markets. Now, the most important indicator I can ever talk to you about, and I can't stress this highly enough, is the trend. Deciphering the trend or the direction of the market you're in is absolutely vital to your analysis. Now, just very quickly on Dow theory, which is the basic tenet of technical analysis, it suggests that all information price, and therefore it's all about price movement. And therefore, if that's the case, then all you need to do is distinguish the overall trend of the price, because if you can understand whether it's a bull trend, a bear trend, or a sideways trending market, it will be able to help you with across all your indicators, in my opinion. For example, my favourite 3 momentum indicators, which are RSI, stochastics, and MACD, they're entirely dependent on whether you know what trending market you're in, whether you're a bullish trend, bearish trend, or sideways trend. The trend is your friend is probably a quote that everyone's heard of if they know anything about technical analysis, and it's widely known because it is true. If you can trade in the direction of your of the trend, and markets do trade in trends, then you're getting much higher probability of success in trading. Now, here we have the trend in oil that we recently saw. And this was WTI across June, July. This was one of the best exponents of a downtrend I think I've seen in an awful long while. And what we saw, I've actually cut this chart off just towards the end of August, actually, as that trend started breaking. And subsequently, the oil price shot, and I mean absolutely belted it higher. As that trend had broken down, the relationship went, and you started to have to change your outlook. Once the trend is broken, you have to start thinking about changing your outlook. But the trend is your friend, and stick with the trend until it ends. And you'll have a much higher degree of success, I believe, in your trading. Okay, so on to my indicators. Now, indicators that I look at are split into price, momentum indicators. And also I look at some other indicators as well, but basically I look at price and momentum. Sorry, I've just seen a question. What is the significance of 144-day moving average? Now, I will get into that as you see on this slide when I talk about moving averages. So just bear with me a sec. First of all, trend. We've just covered this. So identify the trend across a number of different time horizons. If you can sort of take a top-down opinion on your trends, so you're looking at the big macro trends, then you drill down into sort of medium-term and then shorter-term trends, you'll get a much better gauge of the way the market is feeling. And you can decipher exactly how to read other momentum and other indicators once you've got that trend. So moving averages. Now, the reason I look at 144-day moving average is because I use Fibonacci levels for my moving averages, Fibonacci numbers. So therefore, I use 21, 55, 89, and 144. Now, I know a lot of you may use the round numbers, which are 20, 50, 90, and 200. It absolutely is your call. Whatever you feel comfortable with. I like to use the Fibonacci levels, Fibonacci numbers as my moving averages, purely because it sort of gives me more of a sense of it's conforming to technical analysis. But again, it's each to their own. See what works for you. That is the main, again, another main thing that I'm trying to get across. It's all about what you feel comfortable with. Also, I use simple calculations. And I find that moving averages are very good for very quick trend identification, very good for support and resistance. And they can even give you potential trading signals. Now, here we go on that WTI oil chart again, although this is a little bit of a while ago. But look at the 21-day moving average, how often it was used as the basis of resistance through July to January 2015. Then in February, we started to see the market break through that 21-day moving average and decisively break it. And then the market moved sideways. And subsequently, that relationship started to break down. Back to what I was saying about on the 144-day moving average. Moving averages work best in trending markets if you're going to use them as your support and resistance. Support, that takes me quite nicely onto support and resistance, actually, which is the graphical representation of demand and supply. And now what you're looking for is to use, I think, support and resistance in a couple of different ways, really. You can use them in trending markets, whereby, say, for example, if you're in a downtrend, you're looking to use the concept of old support being new resistance. Just for example, say, for example, you bought something at 100p, and that was the old support, and then subsequently that support gets broken. You see the price falling to 90p. Now you've got a decision to make, because you're thinking, crikey, this could go to 70, to 60, to 50. I could lose my shirt on this. But you subsequently see a rebound in the market, and you see that your trade suddenly is up at 100p again, or 100 again, and it's now flat. And you think, wow, this is an opportunity. I thought I was going to lose my shirt on this. It's now an opportunity to close out my position. You do that, and you subsequently see the market falling away from 100p, because that is exactly what happens at old support, where the overhead supply of the buyers comes back in, and you see the sellers entering the market at that level on the rebound. And we can see how graphically illustrated support and resistance is on this is back from 2013 through 2014, so a little while ago now, but still a good idea of what's going on. Now you see the moves between 105.44, which acted as the big resistance, and 100.74, which acted as the key floor. Now look how often, in a sideways trending market, you look for pivot levels. Because you can't really use old support. Well, you can, but you still look for pivot levels where the old support is new resistance, but when you've broken it, that sort of flips around again. So you're looking to pivot around the old levels. And you can see here around the middle line at 102.83 where the red circles are. Time and time and time again, that was used as the basis of resistance through 2014. And you suddenly saw, when we broke through that 105.44, that old resistance becomes new support for the correction, and that was used again almost bang on, and then wallop straight back to the upside. It's really good exponent of this chart of support and resistance. Okay, so Fibonacci levels. Now, Fibonacci, again, I think Fibonacci is getting more popular, and I'm giving it a lot more airtime on my analysis, and I like to add it into my charts. Certainly, very good for retracements, but also that it can work very well to giving upside targets from breakout levels. Your classic Fibonacci levels are 38.2%, 50%, and 61.8%, but there are other levels as well. 23.6%. I haven't actually got it on this chart, but 76.4 is also another key Fibonacci level as well to look out for. Now, Fibonacci is just a mathematical consistency, really. It happens throughout nature in things like shell structure. In hurricanes, you can see it in celestial bodies such as the Milky Way, and etc., etc. So you do see it happening a lot, and it happens a lot through trading as well. And a lot of traders do look at Fibonacci retracements and projections, and they will set them out as support and resistance levels for their trading. So it's a very good indication of where the market could be going. And here we see dollar yen again. Dollar yen through 2014 into recently, actually, 2015. This is a Fibonacci retracement of this 121.84 correction back down to 115.56. And you can see how many times you saw the consolidation around these Fibonacci levels on this chart. Didn't put a little red circle there, could have done. Fibonacci level again. Look at these consistently hitting these Fibonacci, this 50% retracement around this oval here. Then 161.8% as you broke out. Interesting was the level of the target, and then it retraced all the way back, found support and bounced. Again, bounced off the 76.4% level. Not so much in the last week or so, but still, it has a big part to play, Fibonacci. And I will note that also dollar yen is a very good chart for technical indicators. For some reason, dollar yen seems to work very well, and also works very well around candlestick patterns. The Japanese love their candlestick patterns, which is sort of takes me on to, well, not yet, but candlesticks and bars in a minute. But pattern analysis first. Patterns do actually have a big part to play, I think, in technicals. You'll often hear people talk about head and shoulders tops, double tops, triangles and breakouts and flag patterns. But basically, you've got sort of two main pattern groupings, sort of, which are reversal patterns and continuation patterns. Your reversal patterns are basically where your trend is reversing, and you're going to get your tops and bottoms. Your continuation patterns are sort of mid-trend patterns, basically, and they do tend to make patterns such as triangles and flags. Now, this is a double bottom pattern on oil. Interesting that oil seems to crop up quite a lot, certainly on WTI anyway. And you've got a double bottom that you saw on oil on this chart through March time. Now, this is a very good example of why you need to be aware of what market you're trading in. If you're in a bear market and you see a reversal pattern, often you'll find your targets will not meet their expectations, because bear market rallies, for example, there is a very good reason why bear market rallies undershoot their targets, and that's because the market gets a bit jittery again. It sees the fact that it's not too far away from the target, and it starts. People start to get nervous. They start jumping in the gun and entering short positions again, and this certainly was the case on WTI. Similarly, on bull market corrections, you'll often see in a big uptrend, when you see a big top pattern coming through, you'll often see that the pattern may not hit its downside target before the buying pressure comes back in, and that's because of the strength of the buyers. Okay, so single day or single period patterns such as candlesticks and bars, basically they use open, high, low, close analysis. This is all about psychology. This is all about who is winning the day and where the price is at the close in relation to the high and the low. Has it been a bullish day? Has it been a bearish day? Would you class, for example, a big trading bar where you've opened at the low of the day, strongly higher, but corrected back towards the end of the day and actually closed around the midpoint? Is that necessarily as strong a chart signal as it could have been? I would argue no, and you need to be aware that these things. These patterns do happen. Candlestick patterns, you've got things like hammers and shooting stars, doji patterns as well, and also on charts you've got my personal favorite, which are key day reversals or key 1 day reversals. Here we go on the S&P 500 where you've got key 1 day reversals, bullish key 1 day reversal here, a bearish key 1 day reversal in May 2013, big strong trend, bearish key 1 day reversal, subsequent correction coming through. So you do have a lot of impetus for these patterns. Now, onto probably my favourite set of indicators, which are the momentum indicators. That is RSI, stochastics, and moving average convergence divergence, or the MACD lines. Now, think of your momentum indicators just like you're throwing a ball into the air. It basically is... if you think about the fact that as the ball is beginning to reach its peak, the velocity is already beginning to slow down. However, the ball is still rising. And that is exactly the concept of momentum indicators in technical analysis. It sort of tries to add the element of timing to your trades. Do you want to be buying going long into a trade that is very mature in its trend and the trend is beginning to slow down? That is the question. Do you want to be still going long into that trade? And that's basically how momentum comes in. Now, the key aspect of momentum indicators is that momentum is read differently in different markets. And what we see here is that in a strongly trending market, how you read a momentum indicator is very different to how you read it in a sideways trending market. And what I've got here is a couple of exponents of this. Basically, this is cable in a very strong downtrend. You can see through July 2014 all the way to January 2015. The RSI never got above 50 throughout this whole trading period. So basically, you can't use the classic signals of between 30 and 70 because you go well below 30. There's no point in sort of closing out your positions if you're sort of continuing to see the momentum falling away. But also equally, you never got towards 70. So that you can't use your classic signals. You need to sort of recalibrate your signals. And in this instance, very well recalibrated around 50. All the rallies fell over around 50. So that was where you're starting to get the trend falling over, the trend losing impetus already. The trend is so strong to the downside, so strong in the bearish outlook that the momentum falls over around 50. And that worked time and time and time again throughout late 2014, and the whole point being you want to be using any sort of buy signals are not considered to be classic buy signals. They're considered to be signals to take profits on your short positions in this instance. So here we go in October and also mid-October, again in November. It's all about using that as an opportunity to close out your short positions and lock in that profit, and then you can start to get back in again once it's unwound. And once you start to break through 50, what do you see? You suddenly start to see the trend being broken, and cable started to rally. This is a sideways trending market, and again the RSI. This is on dollar yen. You can see you can use your classic buy and sell signals. There's another signal you get off the RSI, or momentum indicators, which are bearish divergences, basically whereby the price is still rising. However, the momentum is falling away. That is sort of part of the whole concept of that throwing the ball into the air. And once you start to see that coming through, the bearish divergence with the price, you start to think, well, maybe this is going to be turning around very soon, and I need to be aware that this is about to happen. So subsequently after that, on the 21st of Jan, you started to build a sideways trending market. And every time you got towards 30, it's a buy signal. Every time you get towards 70, it's a sell signal. Again, you sort of need to be a little bit nuanced with your indicator here, sort of low 30s and high 60s, but still the same rings true. When you're sideways trending, you can play the classic overbought, oversold signals on your momentum indicators. Similarly, it works with stochastics and also, to a certain extent, also MACD lines as well. Although MACD isn't strictly speaking a momentum indicator, it does still sort of ring true and has got many hallmarks of momentum as well. So I sort of lump it in with that. Okay, so volatility. Now, volatility, I think, is actually something that I'm again increasingly using. Bollinger Bands. I think they give very good signals. Actually, Bollinger Bands. I think, especially in extreme markets, be it extremely benign markets where the volatility is extremely low, or whether the volatility is extremely high, I think you get very strong signals on Bollinger Bands. What you need to do, though, with Bollinger Bands is make sure that you get a confirmation with other indicators. It's not necessarily an indicator that works especially well on its own. However, you're looking out for, as I said, the two main ways that I use Bollinger Bands are for breakouts and reversals. So you're looking for breakouts from narrow trading bands, which I've got here on dollar CAD back in December 2013. You had this narrow trading band on dollar CAD where the bands came together. So you could argue it actually happened here as well, but you actually got this period of sort of a couple of weeks where the bands came together, and then you started to see the breakout. You started to see the breakout moving higher, closing above the bands, and then you go with the breakout, and you suddenly start to see a strong trend. So you're basically looking for periods of low volatility, and the breakout of the bands actually signals upcoming higher volatility, and you want to trade with that move. Now, in a similar scale, way, you want to look at for reversal signals outside wide trading bands. So when the trading bands are extremely wide, and the price trades completely outside the band. Now, statistically, Bollinger Bands give 95% of the price action inside a 2 standard deviation Bollinger Band. So if you're trading outside extremely wide bands, you've got very strong volatility anyway in extreme moves, and not only that, but if you get a close outside or a trading day outside the bands, and then you get a move back inside the bands, that is an indication of a reversal on Bollinger Bands. Okay, so volume. Now, in the last few days, we've actually had volume signals again confirming for me that, or giving a very strong indication that we have actually hit the low recently. Volume is best used as a confirmation tool again, because you want to see your breakouts coming on a high volume, but also you want to see extreme highs and lows coming on high volume. And here we have the FTSE 100, and you can see throughout late 2014 and sort of just recently, actually, the extreme volume moves reflects the sort of extreme moves in the market. Here we have, especially in 2014, this late one in 2014, couple arguably higher volume. You've actually got sort of arguably one here where you see the you sort of see the confirmation of the strong move. But here we go on recently. You had that massive sell-off in the markets amid the big volatility, and what did we see? We saw huge volume, FTSE 100, on that very day that was the volumes that was the down day. The lowest day on the chart. Now we've had the rebound since then, and markets sort of around, but it's still not retested that 5,000 sort of 700 odd level in line with that big volume. And my final indicator that I use are Parabolic SARs. Now, I am increasingly using Parabolic SARs because I think that they're very good in terms of knowing how to play your trends, exactly how long to stay in the trend for. They work very well in strongly trending markets, and they work similarly, I suppose, to your trailing stops would do in your trading platforms. And I can show you here where dollar yen, you see a sideways trending market. You basically got the parabolic SARs of the red dots, and the concept being when you hit the red dot, you flip the outlook, and you start to sort of trade the other way. Now, in a sideways trending market, parabolic SARs do not work very well because obviously the SARs are tripped left, right, and centre. Parabolic SARs stands for stop and reverse. But then you started to see in August 2014 a strong trend developing, a breakout and a strong trend. And look at how long, if you traded on the breakout of this trend, you'd have been able to stay long on this chart with the parabolic SARs all the way through September, for about 6 weeks, in fact, and you've been able to run from, say, around 104 area all the way to 109 before you started to see this parabolic SARs tripped. Parabolic SARs in October 2014 got tripped on a bearish key one-day reversal. So not only was that a sell signal or take profit signal on the tripping of the profit of the parabolic SARs, but also you had a bearish key one-day reversal, which subsequently saw a big correction. And then in October 2014, again, you started to see the trend building once again, and you could have run those parabolic SARs. It depends on exactly how you would have done your trading. You certainly would have been long on the breakout above 110, and then you would have been able to run that trend all the way higher, all the way through to sort of 118, 119 area, at which point you saw in late November where you got the parabolic SARs trip. So when the market is trending, your parabolic SARs can work very well as an indicator of exactly when to take profits. Right, so just as a quick summary of all that, I'm trying to identify trending markets whether you're in a trending market, whether you're in a ranging market, because exactly how you use your indicators completely changes in each of those markets. In a trending market, obviously you're using trend lines, and you're using old support as new resistance and vice versa. Use moving averages as a very good gauge of support. So just check your moving averages and see which ones are working well. Using MACD lines as well. MACD again works very well in a trending market. Fibonacci projections for your breakout targets I think are very good. And as I've just discussed, parabolic SARs also work very well in trending markets. In a ranging market, as I described earlier, you've got the RSI buzzing between 30 and 70. Use the classic support, classic momentum signals. In a similar way, use the classic support and resistance as well. So you're using buying at support and selling at resistance. Same sort of game. Fibonacci retracements, I think, work very well in ranging markets. And also using sort of classic Bollinger Bands buy and sell signals. And that sort of is the end of that part of my presentation. So what I'm going to do now is we're going to look at some live markets and see what the outlook is at the moment. Now, if anyone's got any ideas that they want me to look at, please feel free to message me on the chat box, and I will go through some stuff for you. Now, what I'm going to start with is the forex majors. So, okay, I will. DZ Bista. Sorry, I can't read. Loonie, I will have a quick look at the Loonie as well. I'll start with euro dollar though. here we've got euro dollar. Just incredible volatility on euro dollar, really. It's still flying around. Today's ECB press conference has knocked another 100 pips off euro dollar. Big dovish press conference. Back towards this key pivot band, 110.50 to 111. These are two big pivot levels. If I zoom out here, you can see time and time again, 110.50 and 111 have been used as the key pivot points on this chart. And we're back to 111, so we're back into this realm of, is this pivot level going to hold? We're 10 ticks away now of this, but you're looking increasingly as though you could well start to see a bit of a bearish move now on the euro. We've broken the initial support of 111.55. Also, I'd noticed in the last few days that 21-day moving average had been supportive. That's been broken. I think this is just sort of indicative of what we're going to see, I think, on euro dollar, which is a range bound play, playing around the key pivot level there, and we're back at that support. So it'll be very interesting to see if the support holds, because these momentum indicators are beginning to turn negative again. On the hourly chart, if it works, please work. Anyway, there we go. On the hourly chart, this is what we've seen. That's the two pivot levels in on the chart here. Zooming in, you've had a breakdown. You're sort of consolidating sideways in the range, really, and then that was a couple of hours ago when we saw that ECB press conference. The pressure remains, but 111 is still intact. You've got a series of lows in the last 3 hours that support has been holding. You've also got the RSI on the hourly chart, which is towards oversold. So if this is going to be the start of a trend, I think you're going to start to see the RSI falling sharply away again. So that'll be very interesting to see. Okay, well, let's look at the CAD. Do it on the daily first. Now, I looked, here we go, interesting, really interesting, because I talked about this on CNBC the other day, actually. I was talking about the fact that it was very interesting that the CAD has been very, very weak for a long while, really long while, ever since sort of over a year, in fact. We're now starting to see bearish divergence on the momentum indicators. You're also in this uptrend channel, and I think that you're going to get uptrend channel tested. You've got the initial support of Monday's low 31.10 area, but look at these momentum indicators, all of which I think, well, certainly the MACD lines and the RSI are bearishly diverging. Look out for the RSI falling below 50, I would say. Also look for the stochastics falling below that mid-August reaction low. If you start to see that, I think you could start to see this trend coming under pressure. You've got the 21-day moving average again as well as an indicator of support. So you've got that little confluence of the 21-day and also the uptrend channel coming in now. So that trend channel is under pressure today again. And I think that with this bearish divergence on the momentum, is this a sign that this trend channel is going to break to the downside? It'd be very interesting. To help that, I think you probably need to see oil stronger, because there is a big positive correlation between the WTI and the WTI and the CAD. Yeah, I think it'll be very interesting to see what happens in the next few days. But certainly if oil starts to rally, I think you could well see the CAD strengthening. Not a much more that I can say, but just in the last couple of hours, we've had a strong move actually on the CAD. All right, let's look at cable. Shall we? Again, I talked about this on CNBC the other day, and I'm of the opinion that I think cable is a sideways trending market. And the reason, well, basically, I think that cable has been in this sort of sideways trending market for like 3-4 months now. And I think the fact that the RSI factor was 30 now brings us to a crossroads. If we're going to see cable still remain in this sideways trending market, I think that we're going to see a rally from here. And that would maintain the premise that the RSI around 30 level is still a buy. Look at the stochastics starting to turn around. Are they starting to turn around? We had this doji candle yesterday on cable, open and close basically at the same level, and that sort of suggests that the trend is maybe slowing a touch. However, obviously we're still in this downward phase. We're now into 8 days of downside on this cable chart. But look, 50% retracement. The fib levels have been pretty decent, I think, historically on cable. But 50% is a decent support there, and we'll see. It'll be interesting to see if that starts to help the cable find support. I think if you broke below 51.70, which is that reaction low in June, I think then you're going to start. That would be confirmation for me that the outlook is negative on cable. But certainly for now, I think you're still just hanging on just to this outlook. Now, the last few days, obviously lower highs, lows throughout, bearish. On the momentum indicators, RSI falling over at 60, coming back towards 30, MACD lines consistently falling over neutral. That is all bearish stuff. So you're still in a negative sort of near-term outlook. However, I'll be very interested to see if this is the level or this sort of is the area at which we're going to start to see support coming in. I'm going to look at dollar yen. But I don't like dollar yen at the moment. Dollar yen's really difficult to forecast. I think you're seeing dollar yen all over the place. Just huge moves, down, up, down. Again, yesterday we saw a huge rally again, and that rally has just not really gone anywhere. It's actually been a bit volatile today. Not really doing a great deal. Now, I talked previously about 120 on dollar yen being a resistance, and that became supportive, became resistance following on from the breakdown a couple of days ago. And we are back below it, but I think just generally speaking, dollar yen is really difficult. It's sort of beginning to settle down now and into a sideways sort of range. Looking on the hourly chart anyway. Fibonacci levels have been virtually useless. Well, not virtually useless. Have been not great on this retracement of that huge sell-off. So it's not. I'm finding it a bit difficult on dollar yen at the moment. Right, Aussie. Big breakdown on Aussie again, and Aussie and Kiwi actually, but Aussie has had this big breakdown. Just zoom in. Here you've got the support initially that comes in around that sort of 72.10 mark, and the resistance that comes in sort of around 74.40, I think it is. 74.40. And having broken down from that sort of ranging period, we're now seeing the Aussie sort of found resistance at that breakdown and falling away again. So lower highs, lower lows, pretty much classic bear market territory stuff. Momentum indicators as well. Every time you see the RSI get back towards 50 at the moment in this big trend, you see that selling off, and everything's pretty bearish. You can get a downtrend in on the Aussie, I think. I do believe. Not too bad. It's not perfect, but it's not bad. You could argue that certainly is a downtrend in place there. So you'd be looking out for that sort of maybe a rally back towards the downtrend area if you did start to see this one unwind, because there is room for an unwinding rally. But again, the resistance comes in around 72.10 area. So there is room for 180, 190 ticks. But again, it would be, I think, a near-term move in this market. Quickly at the Kiwi. Kiwi is better than, generally better than the Aussie. And interestingly enough, the Kiwi has actually started to rally a bit against the dollar today. And maybe that's an oil-related move, coming to think about it. Oil is up 3% as we speak. So, yeah, maybe it's an oil-related move. Both the loonie and the New Zealand dollar are rallying against the US dollar. So it could well be another couple of markets that are linked to that oil rebound today. But again, we've seen this breakdown of the chart below sort of that 65 area. 67.40 is that resistance that comes in from this range pretty much, but 65 figure is sort of where you're seeing that old support becomes new resistance now. Those few candles there falling over at 65 area. So that is the level that you'd need to get through. You do have very slight bullish divergence, you could argue, on this RSI, although it's not amazing. The lower lows on the price, the higher lows on the RSI. But yeah, I think it's the Kiwi dollar is more positive than the Aussie dollar, certainly will be, but neither of which are that positive. Right, let's look at gold, because I don't think I've got too much longer left, but who knows? Maybe I will. Yeah, disappointing, I think, on gold. The fact is that we had this sort of rebound off 1,117. It's actually a pretty decent rebound, and then just last couple of days it's fallen over again. What concerns me here is the stochastics, really. You've got the stochastics falling, having actually given a bear kiss, where the stochastics come together and then carry on going down. That's a bear kiss, and that doesn't look great near term anyway. And the fact is that we've sort of broken, although we've sort of rebounded back off it, we've broken back below that 21-day moving average, and also the initial support at 1,125 got broken as well. This is the hourly chart where you've got this sort of sequence now of lower highs, last 2 days or so, falling away, putting pressure now on the lows. It certainly looks as though you could well see that support at 1,117 tested on this chart. So it doesn't look great. Momentum indicators as well. That RSI is confirming the move. Went oversold, rebounded. So maybe that is the rebound in the last couple of hours. If you see it sort of unwinding back towards the 40s area, maybe that is a chance to sell, because that seems to be now a bit of a resistance. And you got the MACD lines in negative configuration as well. So I've talked about it a couple of times, so why not I do a live analysis of NYMEX. See what's going on here. Wow, just the volatility is just incredible. It's made it so difficult, I think, in the last few days. I was thinking that this could have turned into a head and shoulders top. We didn't really get the confirmation of the move, and we saw subsequently, and that was the point at which oil yesterday was down 4% on the day. It has, it's rallied 10% since then, pretty much 10%. 8-9%. So it's just an incredible move you've seen on oil. Again, in the last couple of hours. Interesting that has been driven. I think that's driven that move on the loonie and also the Kiwi. So watch out for those two charts if this oil price continues to rally. That big resistance comes in 49.33 on oil. But look, just the size of the candle. Obviously, we had this very, very solid downtrend that I talked about earlier. But once that downtrend was broken, it just carried on going, and just the volatility is just incredible on this chart. I think it's going to be a brave man that calls, or man or woman that calls exactly where oil's going to go. I mean, I was doing Tip TV today. I looked at my charts last night as I was preparing to sort of go home, and I was thinking, well, this chart could potentially be a big top pattern on the hourly chart, and I was all ready to go and talk about that on Tip TV today. And then suddenly we saw this huge rally into the close, 6% turnaround on into the last few hours of trading, and it's just consolidated a bit and carried on going. So you've got to look higher again. You've got to look at the resistance levels. 48.90, 49.33 are those two resistances. So just incredible moves that we've seen on that chart. Let's look at silver then. Silver's breaking higher. Interesting, because gold was under pressure, but silver, which has been under more pressure than gold, actually, to be fair to it, silver's actually sort of continuing this little rally it's had, whereas gold sort of got sold off yesterday. Silver's actually up, which is really interesting. It's pretty choppy, really. I don't think you can really sort of give too much of a conviction outlook on this silver chart, but it certainly looks like the last few days has been up. I mean, the momentum indicators are fairly neutral, really, not really giving too much away. Moving averages, sort of certainly the near-term ones are flattening off, and it could well be that it's going to start to maybe start to trade around sort of a range play, sort of near-term. 1550 is the big overhead resistance on silver. Old floor there that came in as new resistance, so 1550, but obviously we had that big sell-off on silver back towards 1390 area, and it's just unwinding that move. I suppose, let me just actually I'll do it on the hourly chart where you can get more of a gauge on this move. Let's see what the fibs do. There we go. Look at that resistance that was in at that 50% level. It had a big spike through that, but actually unwound straight back into it. In fact, very interesting. But that 50% level is clearly near-term resistance, and it had an attempt at it, but couldn't make it. So you're sort of more sort of as a consolidation play, really. And again, look at this Fibonacci retracement, 23.6 providing the floor, buzzing around that 38.2%. Look at that throughout. That's actually a really good fib, I have to say. 38.2%. Look at that, 1459, 1460. Time and time again, provided the support, provided resistance, and then support hourly. Sort of traded below it a little bit, but again, it's providing the support. So you are seeing these fib levels on this hourly silver chart acting as a decent gauge. All right, let's have a quick look at from FX Boyke. Not heard much from you today, but let's have a look at dollar rand. It's one I have to admit, this is one I haven't looked at for a while. So just give me a sec. Wow, I mean, that's just not stopping, is it? That is pretty solid, strong chart. It's actually accelerating away. You'd stick with it, stick with that trend. There's no reason to give up on that trend. I mean, it is indicative of a lot of the emerging market players, I suppose, at the moment. I know that South Africa is having a lot of problems with its currency deficit. Its trade deficit, and it certainly is reflected in the weakness of that dollar ZAR chart, or the strength of that dollar ZAR chart. What a big move that is. Is it getting extreme? Well, interesting. You've seen a key 1 hour reversal. So maybe you're going to get a correction back towards maybe a support band, 1340 area. That's a decent support band you've got on this chart. Got the RSI that went a bit. You've actually had a sell signal on that RSI very near term. So maybe you're going to get that chart unwinding a little bit back towards maybe the 40s, maybe the 50s. It's up at 60 at the moment. There is room for this to unwind, I would say. So I think you could see also, wow, look at that, stochastics on the alley, giving a sell signal just on the brink of being confirmed. So you're seeing very near term that this chart is turning around, but I think it's just going to be a correction within the big trend, which is clearly very strong on this chart. Are you clear to? Are you near to any reversals where it doesn't look like at the moment? Although the RSI is pretty historically overbought, the momentum is still pretty strong. You've got these stochastics which are nicely rising as well. So everything is looking still as though you're buying into dips on this chart. So maybe use this little correction as a buying opportunity on dollar ZAR. Right. I think at that stage, I'm going to just quickly run through a little bit about Handtech, give that opportunity. Here's the Handtech website. All my stuff goes on here under the market research tab. And there it is. All my stuff gets put on there. My morning reports, my blogs, my videos, etc., etc. I do daily videos down the side here, or you can go into the morning reports and you get the videos at the bottom of the page here as well. My Twitter handle is at HandtechRich if anyone wants to follow me. And thank you very much for your participation today. And I will leave you again with that disclaimer. So thank you very much, guys, and I will speak to you again next time.